Welcome to the Deep Dive. We're here to pull out the vital insights from the latest earnings calls.
Yeah, we cut through all the noise, basically, delivering the key takeaways so you can quickly understand what really matters.
Today, we are diving deep into Solesence's Q2 2025 earnings call.
Right. They're a company that specializes in mineral-based UV tech and protective beauty stuff. They work as a CDMO.
A contract development and manufacturing organization.
Exactly. For lots of skincare, cosmetic, and sun care brands, they develop and make products for others.
It's a really interesting look at a company trying to scale up its pretty innovative technology in a market that changes fast.
And there's quite a story here from their latest results. Looks good on the surface? Maybe.
Let's kick things off then with a quick snapshot of the Q2 financials. They hit record quarterly revenue, $20.4 million.
Which is a huge jump, right? 56% year over year.
Yeah, a very strong top-line number. Shows demand is there.
And profitability. Gross profit was up 55% to $5.9 million.
Which kept the gross margin at 29%, flat year over year.
But importantly, that margin improved by 6 percentage points from Q1.
Sequentially.
Okay, that is interesting. We'll need to unpack that. Net income landed at $2.7 million.
And adjusted EBITDA hit $3.49 million, both way up compared to last year.
Operationally, things were moving too. Shipment volume up 102%.
Wow.
And production volume up 127%. Again, year over year.
So, I mean, if you just glance at those headlines,
You'd think, fantastic quarter.
absolutely. But as we often find, the market reaction wasn't quite so simple.
No, there was a definite sense of caution, almost skepticism, immediately after the call.
Which hints that investors were, let's say, looking under the hood a bit more closely.
Right, digging past those surface figures.
And that's really the puzzle we need to solve today, why the caution despite those numbers.
Okay, let's do it. Let's unpack this. That record $20.4 million revenue, where did that come from?
Management pointed to strong commercial execution and high demand for consumer products.
Especially from their big clients. Yeah, their largest customers, including a significant new brand partner they brought on board, and also color science.
Okay, so capitalizing on peak season, it sounds like.
Definitely seems that way. Now, what's really interesting is that sequential gross margin improvement you flagged.
From Q1 to Q2.
Management said that was basically them getting past those Q1 production startup costs.
Related to the new product line for that new partner.
Exactly. And they also pointed to just general gains in operational efficiency.
Okay, efficiency gains. What specifically did they do? Any details?
They mentioned optimizing production line use and labor, getting more out of what they have.
Makes sense.
And crucially, implementing something they call first-time prime manufacturing.
First-time prime. What's the idea there?
It's about getting production right. Basically perfect from the very beginning, minimizing rework, cutting waste and costs.
Okay, so a quality and efficiency focus. That sounds pretty strategic for a CDMO.
Absolutely critical. Now, let's zoom in on that net income number, $2.7 million.
Right, because this is where it gets really interesting for investors, I think.
Definitely. That number included about $1.2 million cash plus interest from the government's Employee Retention Credit Program, the ERC.
$1.2 million. That's a huge chunk of the $2.7 million net income.
It is. And while management called it a nice boost to cash, which, sure, it is.
It's a one-off.
Exactly. It's a one-time gain. And if you're an investor looking for sustainable organic profit,
then this kind of masks the underlying operational performance a bit.
Precisely. It makes it harder to see the core engine's health. So it potentially led to that more skeptical view of the reported net income and the adjusted EBITDA too, which also included it.
So the market was basically saying, okay, great number, but show us the profit without the one-time help.
That seems to be the message.
Yeah.
Okay, moving beyond the core financials, Solesence also made some big strategic moves in Q2.
Right, like uplisting their shares to NASDAQ Q at the start of the quarter.
And subsequently getting added to the Russell 3000 and Russell 2000 indices.
Why does that matter for investors? What's the goal there?
Well, it's really about visibility and access. It gets the company on the radar of more investors, especially bigger institutions.
Increases liquidity too, right? Makes the stock easier to trade.
Absolutely. It signals they want to move from being a niche player to a more established, scaled platform. It's a maturity signal.
They also boosted their financial flexibility, didn't they? Amended some loans.
Yes, in May. They increased their maximum borrowing capacity quite a bit, from $14.2 million up to $23 million.
And pushed out the deadlines, the maturities, to April 2027.
Yeah, giving them more breathing room. Connect that to the bigger picture.
More working capital, especially for a seasonal business.
Exactly.
Yeah.
And it de-risks their growth plans. Lets them buy raw materials, maybe on better terms, improves lead times for new product launches. It's about having the financial fuel for their ambitions.
Makes sense. And operationally, they seem to have fixed those Q1 issues.
Yeah, they reported resolving all the production problems with that new brand partner. And crucially, they're getting new orders from them.
That speaks volumes about customer satisfaction, keeping them happy.
For sure. They also mentioned reducing inventory levels by about $2 million, or like 9.5% from Q1, trying to rebalance things.
Okay, what about innovation that's core to their model?
Right, they highlighted that too. Showcased some new white label products at Cosmoprof North America.
Like that Color Ninja Correcting Cream SPF 50 Plus Par.
Yeah, featuring their Clear technology, which isn't just branding, it's key tech for them.
How so? What does Clear do?
It lets them create mineral-based UV products that are stable, lightweight, feel nice on the skin. They avoid that, chalky feeling you sometimes get.
Okay, so it makes mineral sunscreens more appealing.
Exactly.
Yeah.
Which positions them perfectly for the whole clean beauty trend, and especially the growing demand for reef-safe sunscreens. Regulations are pushing the market that way.
So they're riding some positive industry tailwinds there.
Definitely. Okay, but looking ahead, management did signal some caution for the second half of 2025.
Right, they expect demand to moderate a bit.
Based on a few things. Softer macro conditions overall, typical seasonality,
Summer ending.
brands taking longer to make purchasing decisions, and also uncertainty around tariffs.
Okay, some headwinds, though they still expect a record revenue year overall.
They do. But that tariff question is interesting. How will they handle potential cost increases?
What did they say?
They expect to pass all new tariff expenses through to customers without hitting their own gross margins.
Bold. Okay.
And they also projected more cost cuts coming, aiming to lift those gross margins higher over the next few quarters, more in line with a tech-driven company.
So managing costs actively. What about demand indicators? Did they give any forward-looking metrics?
They highlighted their shipped and open orders number, over $60 million in Q2,
How does that compare?
up from $50 million same time last year, and up from $45 million just back in May. They point to that as a sign of current demand strength.
Okay. And leadership. Any changes?
They mentioned the CFO search is active, and an announcement should be coming soon. That's always something investors watch.
Definitely. Did the Q&A shed any more light, particularly on margins?
Yeah, and analysts specifically asked about profit margins, reflecting those investor concerns we talked about.
And the response?
Management basically reiterated that Q1 had those startup issues, which caused inefficiencies.
Right, the resource allocation troubles.
Exactly. So now they're laser focused on optimizing the production lines, labor use, and pushing that first-time prime manufacturing.
To drive sustainable margin improvements, not just rely on things like the ERC.
That's the goal they're signaling, yes.
Okay, so let's try and pull this all together. What does it all mean?
Well, you had management sounding pretty positive, right, on execution, capacity, financing.
But the market reaction was clearly cautious. Shares dropped significantly after the call.
Right. A real contrast to the headline numbers.
Which, as you said, strongly suggests investors look straight past that one-time ERC boost.
Discounted it as non-recurring, not indicative of the core business's earning power.
And probably worried about margin sustainability.
And the impact of that expected slowdown in demand for the second half.
Yeah.
Quality of earnings seems to be the key concern.
And when we look at Solesence versus the broader sector, like the materials ETF, XLB.
Solesence has actually underperformed XLB over the last 1 and 3 months.
So it wasn't just the whole sector dragging it down, it was company-specific concerns.
Seems that way. The market reaction was targeted.
Even though the big picture trend demand for reef-safe, mineral SPF is still very much in their favor.
Absolutely. The industry backdrop is favorable for their tech. But the market right now seems more focused on near-term valuation and, again, that quality of earnings.
They want proof of consistent organic margin expansion.
Exactly. Show us the money, but show us it's coming from the core operations reliably.
So what should you, the listener, watch for going forward? Near-term catalysts.
Well, obviously how they execute in Q3, which is still seasonally strong. Any updates on that margin improvement path?
The announcement of the new CFO will be important.
Definitely. And of course, the Q3 earnings report itself, probably late October. That will be the next big data point.
Okay, now let's shift gears slightly.
Oh.
Welcome to our This Is Not Financial Advice segment. Time for an outrageous but maybe plausible trade idea. Think hedge fund pitch meeting.
Okay, let's hear it. Given that market caution around Solesence's Q2, the ERC factor, the softer outlook.
Right. Here's the idea. The ERC hangover paired play.
Okay.
Consider a short-term bearish view on Solesence, say, through Q3, maybe a small short position.
Or maybe buying some out-of-the-money put options.
Exactly. Those puts give you the right, not the obligation, to sell the stock below its current price, so you profit if it drops.
Well, the logic.
The market clearly discounted the ERC boost. Demand is expected to moderate. So Q3 results, without a similar one-time gain, might disappoint investors still anchored on the Q2 headline profit.
Potentially leading to another price drop or adjustment.
That's the bet. But to hedge.
The paired part.
Pair it with a long position in the materials sector ETF, XLB. Well, Solesence has underperformed it recently, so this hedges against the whole sector doing well, while you're specifically betting against Solesence short term. You capture sector upside if it happens.
Okay, so profit from a potential Solesence valuation reset, but stay exposed to the broader materials sector just in case. What's the exit?
Cover the short or sell the puts right after the Q3 earnings release. Or if they announce a really strong CFO and show concrete evidence of sustainable non-ERC margin growth before then.
So it's basically a bet on the market fully digesting the non-recurring nature of that Q2 profit boost.
Pretty much. A bet on rationality catching up. Short term. But again, not financial advice, just an idea.
A provocative one for sure.
All right, that wraps up our deep dive into Solesence's Q2 2025 earnings call.
We saw strong top-line growth, definitely some operational improvements, strategic moves.
Like the uplisting and getting more financing flexibility.
But the real story, I think, was the market's reaction. That focus on the quality and sustainability of earnings.
Yeah, clearly discounting that one-time ERC money and worrying about future demand and margins.
So the focus now is squarely on execution. Can they deliver that sustainable organic margin growth? Can they navigate the softer macro picture in the second half?
That's the key question. As always, remember, this is not financial advice. We're just here to share insights.
Right. Keep digging into those numbers yourselves.
For more analysis on the companies moving the markets, join us next time on The Deep Dive.
Until then, here's something to think about. Will Solesence's operational tweaks and cool, clear technology be enough to overcome those broader economic headwinds and convince investors their growth is real without the one-off boosts?
We look forward to exploring more with you soon.